Most people assume the Federal Reserve is a government agency. It is listed alongside government institutions. It is run by a chairman appointed by the president. It reports to Congress. It controls the money supply of the United States. And yet, it is not a government agency. This is not a technicality. It is not a conspiracy. It is a structural design decision made in 1913 that shaped the entire architecture of the American financial system, and it explains almost everything about how monetary policy actually works in this country. To understand what the Federal Reserve actually is, it helps to understand what it was designed to replace. Before 1913, the United States had no central bank. It had a fragmented, decentralized banking system where thousands of individual banks operated under different rules, issued different currencies, and had no coordinated mechanism for responding to financial stress. When a panic occurred, and panics occurred regularly throughout the 1800s, there was no institution capable of injecting liquidity into the system. Banks failed. Depositors lost savings. Commerce seized up. The system had no lender of last resort. The Panic of 1907 changed the political calculus entirely. A severe banking crisis nearly collapsed the U.S. financial system. It was ultimately contained not by any government action, but by a single private individual, J.P. Morgan, who personally coordinated a rescue of the banking system using his own relationships and resources. The fact that the financial stability of the United States depended on the personal intervention of one wealthy banker was widely understood as a structural failure. Congress began designing a solution. On one side, those who wanted a purely government-controlled central bank, responsive to democratic oversight and publicly accountable. On the other side, private bankers who wanted the new institution to be insulated from political interference, run by people who understood markets and credit, rather than politicians responding to electoral pressure. The institution that emerged from this debate was a compromise, and like most institutional compromises, it is something that fully satisfies neither side's original vision. The Federal Reserve System, established by the Federal Reserve Act of 1913, is a hybrid. It has public characteristics and private characteristics simultaneously, and the balance between them is precisely calibrated to serve a specific institutional purpose. Here is what makes it public. The Board of Governors of the Federal Reserve System is a federal government agency. Its 7 members are appointed by the President of the United States and confirmed by the Senate. The board sets monetary policy, regulates banks, and issues the regulations that govern the entire banking system. The Federal Reserve Chairman testifies before Congress and answers to elected representatives. The system's mandate, maximum employment and stable prices, was set by Congress through law. Here is what makes it private. The Federal Reserve System consists of 12 regional Federal Reserve banks distributed across the country. These regional banks are not government entities. They are incorporated as private institutions. They have boards of directors. They issue stock, which commercial banks in each region are required to purchase as a condition of membership in the Federal Reserve System. Those member banks receive dividends on that stock. The regional Federal Reserve banks operate with a degree of institutional independence that no standard government agency possesses. From the system's perspective, this hybrid structure was not an accident. It was an answer to a specific design problem. A central bank that is fully controlled by the government is subject to political pressure. Elected officials face incentives to expand the money supply, to stimulate economic activity, to fund government programs, to avoid the short-term pain of monetary tightening. A central bank that simply executes the preferences of whoever holds political power is not a credible institution. Markets understand this. When markets believe a central bank will sacrifice price stability for political convenience, they price that expectation into every interest rate, every bond, every investment decision in the economy. The cost of political dependence is embedded in borrowing costs across the entire financial system. A central bank that is fully private is a different kind of problem. A private institution managing the money supply of the world's largest economy has no democratic accountability. Its decisions affect every person in the country. The concentration of that power in private hands without public oversight creates a legitimacy problem that no financial system can sustain indefinitely. The Federal Reserve's hybrid structure attempts to capture the credibility benefits of independence while maintaining the accountability mechanisms of public oversight. The Federal Open Market Committee, the FOMC, is the body that sets interest rate policy in the United States. It meets 8 times per year. Its decisions move financial markets globally. Its membership consists of the 7 Board of Governors, the public appointees, and 5 of the 12 regional Federal Reserve Bank presidents who rotate through voting membership. The presidents of the regional banks are not appointed by the president or confirmed by the Senate. They are selected through a process that involves their private bank boards. This means the body setting U.S. monetary policy includes participants whose selection process runs through private banking institutions rather than democratic election or presidential appointment. The Federal Reserve's independence has real consequences. When the Fed raises interest rates, it does so based on its reading of economic data, not based on what the president prefers, not based on what Congress instructs. When the Fed determines that inflation requires monetary tightening, it can implement that tightening regardless of the political consequences for the party in power. This insulation from political pressure is the core functional purpose of the Fed's hybrid structure. The trade-offs embedded in this design run in both directions. The system gains credibility. When the Federal Reserve commits to an inflation target, financial markets believe that commitment more than they would believe the same commitment from an institution subject to electoral pressure. That credibility is not abstract. It is worth trillions of dollars in lower borrowing costs across the entire financial system, because credible price stability reduces the risk premium embedded in every long-term financial contract. What the system accepts in exchange is a concentration of significant public power in an institution that is not fully publicly controlled. The decisions made in the FOMC affect employment, housing costs, business investment, and the value of savings held by every American. And those decisions are made by an institution specifically designed to be partially insulated from democratic accountability. The Federal Reserve is not a government agency. It is not a private bank. It is a deliberately constructed hybrid, designed to be independent enough to be credible and accountable enough to be legitimate. The tension between those two requirements is not a design flaw. It is the design. The Federal Reserve exists in the space between government and market. That space was deliberately created, and the system has never fully left it.